In this video, we'll rank the most common assets people put their money into from level F to level S, based on real data, long-term returns, and risk. This is not financial advice. It's a practical guide to what really builds wealth and what silently destroys it. Level F, wealth killers. These are not investments, they just seem to be. Lottery tickets and gambling burn more than $100 billion a year in the US alone. With odds of 1 in 300 million, you are more likely to be hit by a lightning bolt than to get rich like that.
Luxury goods, cars, watches, jewelry, designer fashion plummet in value quickly. A new sports car can devalue 50% in 5 years. They are status symbols that drain capital. Speculative collectibles without knowledge, Beanie Babies, NFTs, hype-driven assets almost always collapse. Even legitimate collectibles, such as art or classic cars, suffer from a lack of liquidity. Finding a buyer for the right price can take years. Level F assets have something in common. They confuse consumption with investment. Put $100,000 here, and it will evaporate by depreciation, misfortune, or hype.
Level D, fragile assets. They may work, but only with luck or perfect timing. Gold and silver are sold as safe havens, and historically they are, but yield about 7 to 8% a year, just above inflation. They do not generate income and do not take advantage of compound interest. A single rental property looks profitable on paper, but vacancy, repairs, interest, and taxes often turn the return into negative. Small owners have a higher risk of loss because they do not have scale. Level D assets don't break you right away, but make your money stagnate or bleed slowly.
Level C are stable but not melt builders. They protect money, they don't multiply it. Securities and bonds, especially U.S. Treasury bonds, deliver stability with returns of 4 to 5% per year. Safe but slow. REITs pay consistent dividends, but are volatile when interest rates rise and, in the long term, yield less than broad stock indices. Collectibles with real expertise can appreciate, but liquidity and the need for networking limit the potential. Without access to the right buyers, profits are locked in. Level C assets are good for diversification, but not for building significant wealth.
Level B, reliable wealth builders. Here begins the true power of compound interest. Index funds, especially the S&P 500, yield an average of 10% per year. A $10,000 investment in 1980 would be worth almost $1 million today. They are diversified, inexpensive, and require zero maintenance. Dividend stocks, like Coca-Cola or Johnson & Johnson, offer stable income and security, although they grow more slowly. Scaled real estate portfolios, 5 to 10 units, distribute risk and become consistent income-generating machines. Put $100,000 here, and it grows. Slowly at first, exponentially later.
Level A, high reward, high requirements. These assets generate serious wealth, but require capital, skill, or both. Private equity and venture capital historically yield 12 to 15% per year, outperforming the public market. However, they require high investments, often above $250,000, and lock up your money for years. Franchises like McDonald's or Chick-fil-A can generate six-figure profits, but cost between $500,000 and $1 million to open, in addition to rigorous selection processes. Commercial real estate scales much better than small rentals, with strong long-term returns, but requires down payments of $1 to $5 million. Tier A assets are proven wealth-making machines, provided you have access to them.
Tier S, wealth engines. They are scalable, leveraged, and have exponential potential. Owning a business is at the top. More than 70% of millionaires are entrepreneurs. A profitable business pays in cash flow and in the future can be sold for multiples of profit. Equity in high-growth companies, startups, early investments can generate transformative returns. A $10,000 investment in Amazon's IPO is now worth over $1.6 million. Digital assets, online brands, content libraries, courses, software, scale infinitely without extra costs. That's why the creator economy has surpassed $100 million. S-level assets have one thing in common: leverage. Your effort multiplies.
You don't need complex strategies or privileged access to build wealth. Avoid low-level pitfalls, invest consistently in proven assets, and give time to the power of compound interest. That's how true wealth is built.